You're listening to The Whole Truth, a Resources Rising Stars podcast.
Hedley, it's been a rough few days for resources investors on the market. Have you got some good news for us?
Well, I think the future is very bright. So there's a good reason to be buying things across the junior market now because they've been absolutely trampled in the last 2 years. So I know it's bad news now and it's been bad news for the last 2 years, but can they get any cheaper? We've been buying and we know that in the long term, they're likely to become incredibly more valuable. So that's why I've been tucking things away at bargain basement prices.
Now, there was a line in the Lion most recent quarterly report, and I'm going to read this. It says, the slide in micro-cap resource company equity prices appears to have stabilised at 70% below April 2022 levels, and there has been an improvement in liquidity. Now, that was in April this year in the March quarterly report. That's a rather long-winded way of sort of saying that you think share prices in the resources space, in the junior resources space particularly, have bottomed. Is that right?
It looks to have some of the qualities of a bottom. Now, I know you've got to be careful when you go picking bottoms, don't you?
And being somewhat prejudicial about their quality in particular.
What we track is, what's the group of explorers doing in terms of their price? And it's a hard thing to do, so it's a bit of a rubbery measure, but that chart that we've had of that hit a stable bottom about 6 weeks ago, and it's just kind of bounced along it. Now, there's probably still some stories which are falling, but as the gold price and the copper price in particular peaked up, that enabled some people to raise money. So that definitely improved liquidity. For us to say we've come through the bottom of the market, we need to see liquidity demonstrating that it is improved. And we're not at that point yet, but we could say all this looks like what happens as we start to turn that corner. So that's very much what's in my mind. Whether we've seen the bottom, whether we're going through it now or whether it's yet to come, I'm undecided on, but I think we're very, very close to it.
Now, I think it was Mark Twain who said history doesn't repeat, but it does rhyme. So if you take the view that there's nothing new in financial markets, it's just a question of variations on a theme and on timing. If it peaked around about April 2022, as you said in this quarterly report, history would suggest that a recovery must be, as you say, if not here, relatively imminent. But there is a link, isn't there, between the liquidity you're looking for in share turnover and, in simple terms, interest rates coming off.
Yep, there definitely is. We saw a seismic shift, I think you could say, in risk attitude of the market in early 2022. So, depending what you measure, you'd put your peak at a different date. But for me, it was sort of towards the end of April in 2022, based on the prices that I watch. Now, what brought that about, of course, there'd been the invasion of the Ukraine by Russia. There'd been a complete change in the way that the US dollar system is sort of legally monitored in terms of sanctions and things like that. And we also saw interest rates push from call it a 0 to 2% bracket through to a 3 to 5% bracket. And as that happened, risk appetite just absolutely evaporated. So how do we go from the market that we're in now to a market where investors are willingly taking risk on things like junior explorers? Either you need interest rates to come back down, and I think that's got to be a big part of it. So you're not going to see a holeless boom take place whilst interest rates are still sitting at current levels or threatening to go up. So I think the whole inflation thing needs to wash through. But at some stage, investors start creeping back and saying, well, you know what, it's time for me to start taking some risks. And if they see a light at the end of that tunnel, which might be that the gold price creeps into new territory, perhaps the copper price coming along. We saw pockets of liquidity associated with things like lithium in 2021, 2022. I think the gold market has the potential for that to be much larger, just because it is a much larger market, pertains to a lot more companies. So that's where I see that glimmer. Now, I don't see for an instant that gold doing what it is at the moment, and even if it just continues to tick up and find new record prices, that's not going to take my chart, which is 70% down, back to 2022 levels. But I think what it could do is stabilise it, and if anything, see it start to tick up from that bottom, just slowly to start with.
Now, let's talk about the Lion selection clock. It's a concept that your father, I think, engineered many years ago. For the benefit of our listeners who obviously can only hear and not see on this occasion, it is, as the name suggests, a clock. It's a big hand going around. 12 o'clock or midnight is crash. 6 o'clock is boom. You said recently you think we're at about 4 o'clock. Where does that translate to in terms of where we are in the cycle?
Well, it's probably just before dawn as far as that recovery of sentiment goes. What we find is that if you look back over historic cycles, price movements might not be the same. There tends to be similar shapes, maybe not similar dimensions. So, the market goes up, that's a boom. The market stabilises and comes off, that's a bust. And some busts can be worse than others, and some booms can be much bigger than others as well. So we think that the last 2 years has been a bust, and that's materialised across the micro cap. It's across micro caps everywhere, whether you're selling ice creams or trying to dig gold up. But the commodity price overprint on that in the last 2 years has made it even worse for explorers and prospective mine developers. So we see that bust. If you look at it for it in the BHP price, all you see is it going to a top and then moving sideways. So, but that clock is driven by liquidity, and that produces very, very similar behaviours in the market each time as you go around. So the behaviours that we've been watching are liquidity falling away, numbers of IPOs dropping right off, and we're in a situation now where what we're watching for is that liquidity creeping back, because we think the conditions for it to start creeping back are right.
And the expression, another old adage here, of course, is that the darkest moment is just before the dawn, and therefore on that basis, if you apply that, that's consistent with your view that we're probably at about a dawn.
Yeah,
it's in simple terms for investors, it's probably a time not to be selling, and more likely a time to be bargain hunting.
Well, I think the other adage you've got to insert here is that one swallow doesn't make a summer. So whilst we see those conditions are right, you need to see the second and the third swallow before you can say, right, it's back on.
Right.
And I think probably the problem which a lot of investors have is that they're more or less fully invested the whole time. I think a lot of people have taken money out of the market in the last 2 years. That's consistent with how people have gone to cash, because you can get a return on it now. If you're not, if you are fully invested and you're not cash rich, now is a time where you're probably tinkering rather than buying across it. For me, if the market has another 10% down, then having bought big percentage positions in juniors, which I think have got 10 times upside, it makes very little difference, and I can perfect my position by topping up again when they're 10% down. But if now's the bottom or close to the bottom, that's when I want to be being most aggressive with our buying.
So let's look at the Lion Selection portfolio, Hedley. You talk about cash. Let's start with cash. How much cash do you have in your sporran at the moment?
So the last figure that we published was $66.5 million, which was on the 31st of May. So that figure's 2 weeks old.
And how does that compare to what you've got invested in the market?
We've invested $10.75 million since we sort of made a clear exit in our portfolio in 21-22. On top of that, we've got about $10 million worth of legacy investments, which will be exited or wound down over the next couple of years. So really the focus for me is that 10.75, which is invested, and the 66.5, which is going to build on that portfolio.
I mean, that's a lot of cash relative to your equity holding, isn't it? I mean,
it is.
You are heavily, heavily weighted towards cash. Do you see yourself sort of putting that to work in the market over the next 6 months?
Yeah, definitely. So we've been earning between 4 and 5% on that cash, which is great. That pays our costs, but it needs to be put to work. And I think the thing which a lot of Lion watchers call it, and even shareholders have been cognizant of, is you've got that cash, but for me to become aggressive in buying Lion, we need to see what you're going to do with it and see how you perform. So we've put a bit over 10 in, almost 11. That's gone up 30% since we've done that, and that's in a falling market. So we're exceptionally pleased with that performance, but that's not the performance that we're after. I mean, we're investing in things that we think have multiples of upside, and we want to see that recognised across the portfolio. So, to be buying Lion now, you're looking at the value of the company wholesale and thinking, well, that should be 2 to 3 times higher at the very least as this strategy plays out. And I think, there's a great indication from the performance we've had. But we're very early in that, and we need the cycle to wash that tide in, which is what we're waiting for as well.
What would you say to investors who say to themselves, why would I buy shares in Lion Selection Group when I can just go and cherry pick my own stocks?
To include the answer that I didn't give you before, Lion is going to be aggressively investing over the next 12 to 18 months, and I think you're going to see us establish the portfolio position we want to have. That's point one. The next point is you would want to see tremendous upside across that to be able to put your money in, and we're investing in things through the bottom of the market. So the only way from there is up, particularly because we know that as cycles take place, the boom cycle corresponds with increasing commodity prices, sentiment in the sector, lifting share prices. So that's what we're getting set for. And at the moment, you get a discount on a discount. So these things that we're buying at less than a third of the price of what they were 2 years ago. and you can buy Lion at 2/3 of the price of its portfolio. So our portfolio value is about 64 cents per share. You can buy it for 44 right now. So you're getting a discount on a discount, and you're getting that portfolio for free because all you're buying into at the moment is that cash.
Now, how is that portfolio broken up or broken down, should we say, Hedley, at the moment? How much of it, in rough terms, would you have in gold, for example?
We've got a strong exposure to gold. So the 7 investments that we have made since 2022, and 6 of those have a strong exposure to gold. So I could argue that a couple of them are base metals oriented as well. The reason we've been so strongly exposed to gold is looking at risk and value. The best deals that we've seen in that 2-year period has been in gold-focused companies. So we've been drawn down that path because they're the best deals that we've seen. I've got approval to deploy into a couple of situations. I don't know when those deals are going to occur, but I've got investment committee approval from Lion, and that will take us well outside the gold sphere with at least one of those. And there's a couple of things which are on the watch list, which we're hoping will diversify our portfolio exposure more into the base metal space, and possibly including a couple of other things. So I think you'll see that start to spread as the next few investments go in. But having said gold focused, there's at least 2 of those which have got a strong base metals flavour as well.
And do you have a preference for where a company is in terms of its own lifespan? Is it greenfields exploration? Is it sort of development, production? Is there any weighting there?
The absolute sweet spot for us is where you can see a project which has a pathway to production because you can see the shape around it. And by that I mean, if it's got a resource and it's not quite big enough, but us as geologists can look at it and say, we can see how that's going to get big enough. It's a question of drilling it. And we can put our own sort of view on economics over the top of that. That's the absolute sweet spot. That tends to be where they're most discounted, particularly in a market like this. But having said that, we've got an investment in someone who is a small-scale producer and has a pathway to being a circa 80 to 100,000 ounce producer. That's the most mature in the portfolio. And we've got something which is a greenfields explorer as well. So we've got everything in between. The peak of the curve, if you like, is in that area where a company has a resource, is building on it, and we expect them to get to that critical mass without too much effort.
Yes, and greenfields exploration?
Yeah, definitely. But you've got to be extremely picky with that. I see a lot of stories come in and say, we've got a great exploration target. And I think to myself, well, great. But if you've got one shot at the dartboard and you miss the dartboard altogether, well, we're back to square one, aren't we? So where we've backed greenfields exploration, it's an absolutely exceptional case. And there's one thing in our portfolio which is absolutely greenfields oriented. And that's because it's a company which has the times of upside it has contained within it, if it's successful, and the amount of shots at the dartboard that it can have to find something big and exceptionally valuable is huge. So unlisted company, it's exploring in a part of the world that no one's bothered to look before, but there are quartz veins sticking out of the ground and there's an alteration footprint that says, here's something that for all money looks like it could have something the size of an Olympic Dam or Acadia Hill, which is lurking in the area. There's all the alteration that points to that. What we're starting to find now is copper and gold numbers which support that. It's a question of where it is. So there's nothing drilled there yet, but there's going to be plenty of reasons to drill there soon. And that's a company that we've put $3 million into to hold almost 50% of. So if they find something, that'll double the value of Lion all on its own.
Now, what about your geo risk in terms around the world? You have a heavy focus on Australia. Is that exclusively? Is that your plan to stay only in Australia?
We want to invest all of the money that we put into new investments into Australia. We've been a globally oriented company in the past, and you go overseas for world-class geology. But the problem when you go for world-class geology is that you often have to accept well subpar world-class legal jurisdiction. And it's hard to manage. It's heartbreaking. You can still extract returns, but they're awfully hard work. So if you have to work that hard for world-class geology, I think you might as well stay in Australia. And you can extract wonderful returns from projects in Australia without them having to be so big. It really comes down to the quality of the people and how well they can execute on a strategy and a plan. And we've had no problems finding things which are cheap and have oodles of upside with good people in Australia.
Now, it's often said, particularly by the great legendary Warren Buffett, that one of the keys to successful investing is actually doing nothing. And so you've obviously sat on this money. Do you expect to see, as you said, you're going to put it to work, but could we expect to see Lion being a lot more active on the share screens over coming months?
Yes, I think you could. I know what I'm approved to do, so I've got approvals in place to deploy quite a bit of that money over the next month or so, and I know exactly where it will go if the deals can be made. But I think over the next 12 months, you're going to see us go from circa $11 million invested to sort of more like 30 or 40. We've got sights on getting that money into the market.
Now let's give us your views here quickly. Snapshot on your views on the outlook for gold, copper, and uranium.
Gold's a fascinating one. It always behaves in a way which is counter to what you think it's going to do. It's exceptionally difficult to read, particularly when you go through interesting periods of time like we have. Now, the marginal purchaser of gold since 2004 has been Western financial market ETFs. That's what the price has been set for. So if you look at the volume of gold in ETFs, you track that shape, that will be what establishes the gold price. In early 2022, something broke. And if you ask me what it was, I would say that the sanctions position, which made it more difficult to transact in US dollars if you were someone who had sanctions against you, caused a lot of people to start to think about where they wanted their money to be held. And a lot of Chinese, Russian, Turkish, etc., central banks started purchasing gold in large quantities. Now, I don't want to slip down a conspiratorial pathway here, but there has been a huge appetite in gold in the Chinese market across retail investment and the central bank, which has sprung up in that time. The 700 million people in the Chinese middle class, you can imagine what would happen to the gold price if every single one of them decided they wanted to buy an ounce of gold a year. So I don't know where that fundamental will go. I think it's fascinating that it's sprung up. And we're not talking about something that might happen. We're talking about something that is happening. The purchasing from there is real and it's taken it to record prices. We know that the Chinese market is very susceptible to faddish investment destinations. Real estate at one time has disappeared. And they seem quite cautious on their own investment market. So gold, occupies an interesting position there. And that's one which I think could very easily turn sentiment, because if gold just moves, it takes a lot of companies with it. Copper, it's completely leveraged to not only the strength of the economy, but also this electrification theme. And I think copper is a wonderful place to park money if you can find a place to do it, because it's difficult to find projects, particularly for me in Australia, where you can say, right, that's a project that we've got to be involved with. There's plenty of things which have got copper in it, but just not enough to say, fantastic project. The copper price for the last 20 years has hit up against a line which looks like it probably grows at a few percent per annum, and it's struggled to push against that. Now, it pushed up to that level in 2005 after trading in a similar range at a lower level for decades before that. So what you need to move the copper price above record prices is something that's the equivalent of the Chinese economy in 2005, when it was growing at about 12% per annum. The Chinese economy isn't growing as quickly. It's moving more and more towards a centralised and quite controlled, and dealing, I'd suspect, with the tail end of a real estate bubble. So is that the quality that you're looking for to push copper to record prices? I think the other thing that we said in our quarterly report was on the condition of the global economy. The Chinese and the Americans, I've just commented on the Chinese economy. The American economy is somewhere between an administration which is like Weekend at Bernie's, and if Donald Trump gets elected, well, maybe it's more like National Lampoon's Vacation. So I don't know if either of those economies is what you would look for to push copper to record levels. Electrification, yes, but I don't think that's a short-term thing. So I would expect copper to sort of be where it is, maybe retracing to $8,000 a tonne as a downside case, but its future is exceptionally bright if you can look into the long term. For the short term, I think that's just something that needs to deal with the wash through of how the global economy works. Uranium, I've always been quite circumspect on uranium, and the reason is because we're a fund which invests for project development. Ultimately, we don't tend to trade, and we've never been land bankers. I think we will become land bankers because there's themes that we want to follow which will generate lots of money from land banking, and we've started off down that pathway with a couple of things. But with uranium, the best way to make money is for the uranium price to go up and for you to say you've got uranium. You can torch a lot of money building a mine, and there's some people who are doing a great job of building mines at the moment. If there is a fluctuation in the uranium price, then everything that's been given in their share price could be taken away, because it's a tough market to push into. So that's something that I've always been cautious of. Now, we've entered a fundamental for uranium now, which is very different to what we've seen in the past. Electrification of the world and moving away from a carbon-based economy supports uranium to a great extent. but you need a political will to be able to do that. And so I think the proliferation of nuclear power and for its baseload to be multiplied across the globe depends on political will. I think the US has got it. I think the Chinese have got it, and that's a great sign. People speculate on whether it could happen here. Yet to see that be fully embraced. So, uranium's got this fundamental which on any day of the week, you could have all the global economy saying, right, let's go for it. But on any other day of the week, you could have them falter and just say, well, we'll do that over the next 10 years. And how does that support the price? Well, I think you have to get your agreements done on the right day. So uranium, I think if you're going to do it, you need to have a portfolio approach. You need to be in a couple of companies which are at different stages, and you need to be taking advantage of all the ways that you can make money in uranium, because I think it's got a bright future. But you've also got to remember that uranium at 100 and something bucks is a much higher cost of power than when it was at $50. And utilities don't like paying twice what they could have got it for 2 years ago. So I'm sure that they will be managing their way through this price episode as well.
Hedley, I think that pretty uses just about all of our time, but it's pretty clear you're getting ready to go shopping, I would say. Probably not in a five minutes to fill the trolley, but you're actually looking for opportunities on the balance of probabilities, as they say. This is probably going to turn out to be a good time to have picked up a few bargains. I noticed particularly this month there's obviously a bit of tax loss selling going on. I see a lot of commentary about that. Might be creating even more opportunity in the short term for those who, as you say, have got a few dollars up their sleeve. But definitely many reasons to be positive for those who are prepared to buy and stick and get into some quality stocks. Thanks very much for your time, and we'll keep following line, and we will see you at the Gold Coast Resources Conference, Resources Rising Stars, on September 3 and 4 on the Gold Coast. You're a long-standing supporter and speaker at the Gold Coast. The delegates there love to hear your updates on the markets and your views on where things are going. So we'll see you there in early September. Anyone who follows the Whole Truth podcast would be aware that the conference is the biggest resources investment conference in Australia after Diggers and Dealers. It's free for investors to attend. So anyone who's just listened to Hedley and would love to come and have a chat with him and have a drink with him on the sidelines, you're more than welcome. That's what the Rising Stars Conference is all about. So please don't hesitate to get in touch with us at Resources Rising Stars, and we will happily book you in. And Hedley says he will be more than happy to have a beer and elaborate on some of these themes. Thanks very much, Hedley.
Thanks for having me. Sounds like a lot of beers in September, but I look forward to it.
Thank you.
You've been listening to The Whole Truth, a Resources Rising Stars podcast, produced by Resource Media, hosted by Paul Armstrong for Reed Corporate. Please note that Reed Corporate does not provide investment advice, and investors should seek personalised advice before making any investment decisions.